Good morning, folks, and welcome to another episode with Felix Frey. This time, we're going to go ahead and talk about how and when to trade covered calls. We appreciate you for joining us. As always, going to go ahead and put up my lovely disclaimer here. Obviously, what Felix talks about is based on his experience, his insight, and it's his opinion and his opinion only. I may say some crazy things from here on out. None of our opinions are represented by TradeZero. Felix, where's the market going? What should I buy? I'm joking. You're a man of options. You love trading options. We've talked about a lot of different strategies, right? Complex ones, like condor, strangles, this, that, chokehold, whatever. The one that is the easiest that I feel that people typically get into when they get into options outside of buying directionally is covered call. So let's answer it nice and easy. What is a covered call?
Yes, covered call is one of the simpler strategies. If you own a stock or you own an index like the S&P, you can simply give up some of the upside, sell calls at a certain level over a certain time, and collect that premium. Put it in your pocket. Nothing happens. You keep the money. That's basically the strategy. Good strategy. I would say, it's for longer term thinkers. It's for patient. I would say traders is not really. It's for patient investors, and it's easy to understand and easy to do. There are some traps and there's a little bit of risk, but people say, the way it sounds, I'm long the stock. I sell calls upside at certain levels, maybe 5% up, 10% up over 3 months, 3 weeks, whatever. And if the calls actually become in the money, then I still made a lot of money on my stock, right? And the answer is, of course, yes. Yes, that is correct. So it's very easy to understand, but there are some traps.
Yeah. I feel like it also gets a little tricky because, the wheel strategy, I feel like it's something that is similar, might have a couple of twists and strategies to it as well. But I used to, the dumbest thing I ever did, and this is why, folks, you should never ever listen to me. Felix, I got a story for you. The dumbest thing I ever did, this was maybe about 6 years ago. Square, which at the time was SQ, or now known as Block, had earnings coming out. Let's just say it was trading at approximately $28. What I would do is I would go ahead and buy 100 shares of Square, and I would go ahead and sell deep in the money $20 calls so that I could go ahead and make maybe 15 cents, not percent, 15 cents.
Yeah.
As long as the stock didn't go below 20 or whatever. Lo and behold, the company didn't exactly report well, and I was holding at 18. The cost basis wise, it helped me out because I had the premium.
Yeah. You bought it at 20.
Yeah, but what I'm saying is like there's some risks and silly decisions that you can make with this as well. So what are some mistakes that you feel people make when it comes to covered calls, period?
Sure. First is the mindset. Like I said, you have to be thinking long term, being patient. That's for sure. Otherwise, you can get caught in the whips up and down. I got to buy back. Oh, let me sell it again. It's the patience game, and to some extent, you got to be a little bit like a robot. You got to just if it's a call overriding strategy you're gonna be using, you're gonna win most of the time. Sometimes you're gonna take some licks, but you're just gonna keep on going. And like I said, in this environment, may not be the best because we're just in. I'll give you a perfect example. JP Morgan does this big trade we always talk about. It's not call overriding, it's a collar, but part of that collar is selling calls. They sold calls back when the index was, 685. This index is now 732. So it's 50, almost 47 points higher than where they sold those calls. And that is approximately 70%. So they're underperforming the market now by 70%. And they actually have to do something now. They have to buy those calls back and then try to sell again up, to some further upside. So the traps are not easily seen. It's almost like you have to learn it by actually being in it, and then you go, oh, this is a lot harder. If you're doing shorter term call overriding, what could happen is that you do it once, let's say, and then you get a market like this, and the market goes down 5%, and now the question is, which calls do you sell, right? So you made money on the first one, you made 20 bips on the first one, and you lost 5% on the stock, on the index. So now which one do you sell? Do you sell a little bit lower? Do you sell the same line? in general, if you try to sell the same line for another 3 weeks, you're not going to get that much money, especially in a low volatility name like the Spire Index. And
Yeah.
so what happens is people just start moving the strike down, and now you're down 2-3% for where you were, and you're like 2% out of the money, something like that. And you collect another 20 bips for 3 weeks, and the market goes down another 5%. So now you're down 10% in the S&P, which people will rationalize that I was down anyway, right? And then I was gonna hold it anyway, right? But I made back 40 bips, and then you do it again, and you do another 0.2%, that you're collecting, and the market goes down another 5%. So now market's, in kind of this down 15% range, and you gotta say, okay, I'm gonna do it one more time. I'll just keep collecting premium, and you go another 0.2%. So now you haven't even made 1%. You made about 0.8% of premium, and the market goes down another 3-4%. It's down 18-19%, and you're like, okay, now what do I do? All right, well, let me just go a little bit further. Let me get some more money, and volatility's up a little bit. And now I'll take in 1.5%. So now you're taking 1.5%. You're locked in at a certain level, not too far above where you are, and the market just rips back 20%. Now you're up 20%. Literally from where you started, you were down 16% or so, so whatever it is, whatever the numbers are. But you're down in the position of not doing anything if you had done nothing. And so that's kind of is the trap. Every once in a while, you're going to get that happen in the market where what we just experienced happened. You go down, and then you do this sharp V straight up. And if you had done nothing, no strategy at all, you'd be up. And if you did the call overriding, you're down, So that's why it's basically what I say is long term, because you're going to get those moments, and then you got to spend months collecting those 20 bips again, 30 bips. And eventually over time, call overriding has proved, not in bull markets like this, not in things going straight up, but when things stop going straight up, call overriding is a great strategy to do methodically and over time. And it has proven that you can beat the market by, let's say over 5 years, 20%, 25%. So,
Yeah.
And some people do it better. There's people online that you'll say, I do 30% a year on this stuff. Listen, if the more you make in call overriding, the more you make, the more chance that you have to get chopped up. I would say, especially in single stocks. So that's really the trap number one. It's a big trap. The second trap is not having a large enough portfolio to absorb the risk. Okay. So you don't want to do margin. You don't want it, because you can get really hurt there. Okay. So
All right, hold on. I love that thought. So no margin. That's one. Is there a rule? Like, and I'm just throwing out an example to see what you think and what you can come up with. But like, hey, if your account is $5,000, your risk on a trade should never be more than 500 or whatever numbers there is. Is there like a ratio that you prefer to stick?
Well, here's what I would say. Here's what I would say, and people won't like this, okay? Because it goes against really what everybody tries to say. To do call overriding, you need if you could do call overriding on stocks, you need a very large portfolio, okay? Now, call overriding on the S&P 500, different story, because the S&P 500 is 500 stocks. So essentially, you're using 500 stocks. That's why the volatility is a lot lower. But if you're going to start overriding on like 3 stocks, 4 stocks, you need a larger portfolio to absorb the times where you're going to get trapped, the times where you're going to lose. And that's part of the problem. That's part of the problem. So the wheel is one of these where you get, you sell puts, you get long, and now you long stock, and then, okay, you start selling calls, then it rips ahead, and then you're trapped, and then you sell higher calls, now you have to stock, you go down sharply. People get chopped up pretty quickly if you're not thinking long term, and you're not. So my best advice is no margin, long term, only on indexes if you have less than $100,000.
So
you can do IWM. What's that?
That's what I was going to ask you. Is you said a large portfolio, and I wanted you to quantify it, and it looks like you did because you said 100,000.
Yeah, let's just say 100,000. I would say greater, but 100,000 is fine. You want to spread the risk across the 100,000, and you want to not be too aggressive, and you want to be believing longer term. And longer term doesn't mean the stock goes down 40%, 30%. It's like, you're gonna have to, if you're gonna sell the stock, you're gonna sell the stock, but you're not gonna get paid a ton of money on some of this stuff. And the high volatility names, people say, oh, those are the juicy premiums. They're juicy because the stocks can go down a lot and the stocks can go up a lot. And so it becomes a little bit, again, you're gonna get tracked at some point, and it's hard to fully appreciate it until you actually do it. Okay.
There's tax implications as well, which again, not tax attorney. I don't know if you have any of that experience.
100%.
Please talk to your chief.
100%. I'm gonna give you a real story. Guy calls me up from LinkedIn. I don't even know who this person is. So I'm nice and try to help him. He knew he was a connection of somebody. He goes, oh, I know this person. I go, okay. So I was talking to him. He was part of a consulting company, and his wife, met his wife there, and they both worked at the same consulting company. They had $5 to $10 million worth of stock. Okay. Lived in Connecticut.
Yeah.
Okay. They banked with one of the large investment banks. I won't name them. And the banks had this great idea. You have all this stock all in one position. Why don't you overwrite, start collecting thousands of dollars a month income?
Yeah.
And they said, sounds good. What's the risk? Nothing. It's overwriting. You own the stock. Okay. They get a call 3 years later. You need to post $3 million in the account. They said, what are you talking about? They had they're stock rich, money poor. They said, we don't have $3 million. We have the stock. I said, yeah, a little problem with the stock. We've been overwriting. The stock went down for COVID, down, and then V'd right up. And I mean, straight up. Okay. When nobody thought these stocks were gonna, they were like, oh, this is the end of it. Straight up. They were call overriding all the way up, but they were selling calls, taking premium. It would go through. They would sell longer dated calls, taking the same premium. No money. They're not making money, just kind of matching what they have to pay. And then they kept doing that. And the stock just kept going higher and higher and higher. And guess what? When you're doing that and you're short calls, if the stock pays a dividend, well, they're going to exercise you. Once you're deep in the money with these calls, and they had to keep going deep in the money to get the premium that they were paid because it was going against them. Once you get deep in the money and there's a dividend, you're going to be exercised. And so it was a couple of years later, the stock had run for a year and a half. And literally, I said to him, there's a dividend coming out and they're calling you now because they know, the investment bank knows that you're going to be exercised. They can't do anything about it anymore because they can't roll into another deep in the money because they're all going to be exercised. So the guy was like, he was floored. He didn't understand. And he said, but I thought I was making income. I said, you lost everything from probably 2 years ago. He goes, we didn't make any of that money. I go, no, that money's gone. You're still stuck where it was at COVID times. And he's like, the stock doubled. I said, I know, that's gone. And he was furious. And he was like, oh, so he called me back. I called the bankers. They're a little frazzled. They're telling me this. And I was like, you might want to get a lawyer if you thought that, especially if they didn't lay the things out in terms that are clear. So, it doesn't matter if you're an average person or someone who has $5-10 million bucks, there's a trap. And I'm telling you, that's the one you got to worry about. Index, S&P, SPX, it's all cash settled, that's fine too. But it's just longer term. It's, methodical. You need a big account. Stocks are, 100-vol stocks. Yes, they give juicy premiums, but they also give juicy premiums because they fluctuate tremendously. So, it's easy to understand. It's like poker. Easy to understand, takes a lifetime to master, right?
Yeah, that's insane. Especially, that's the dividends aspect is something that's completely different as well, which is what you kind of brought up there. There's a tax implication because as you're writing these calls, you have short-term capital gains. So you're kind of
right. And that was the point of that. Sorry. The point was that these people had the stock for years. They didn't want to take the tax. And now they had to take, not only did they miss all the profits, they had to take the long-term tax on the stock that they held that they wanted to hold for the next 30 years.
Yeah.
Bad situation.
It really is, because that's what I realized when I was selling covered calls. I was getting all this stuff. And look, I was just doing it as a retail trader. I wasn't the best at whatever. But I was like, oh man, like taxes now are going up. But anyway, talk to your professional folks and make that sure you're squared away. Coming back to covered calls in itself, how far out would you go personally if you were to write a covered call, right? Are we going weeklies? Are we going 30s?
Sure.
Or go 5-day? How far out are we going?
Again, there's no right answer. There is literally no right answer. It's sort of who the person is, investor. 3 to 6 weeks is a sweet spot for a lot of people because the decay starts happening. But this is like, tastes good. Was it feels great, tastes good. What was the Bud Light commercial? The Budweiser commercial. Where it's like tastes great, less filling. Tastes great, less filling. There's always a counter attack here. You get better decay, right? So the premiums start going down quicker. But what do you give up? You give up this leverage that if it goes faster up, you're going to lose multiple times. You have to pay multiple times what you took in. So you take in $1 and then you got to buy back the 5, and now you got to roll to the next further out. So there's no right answer. I promise you that. It's all about do you want to watch this? How much premium you want to take? I would say for most people, and I tell this to members who do some of this stuff, they do the wheel and I kind of guide them. In a market like this, go a little bit longer and go say 5% out, especially after it's made such a big move, huge standard deviation move, maybe 2-3 standard deviations in the last month. Now you can sell 3-month options about 5%, another 5% higher. You're going to still get paid. And you know what? You've already made a good amount on the S&P for the year, and you're going to get capped out at 25%. So it's sort of like helping people understand the worst scenarios. This thing goes through and you're up 25% for the year, and maybe you want to, change your portfolio around anyway, up 25%. That's hard to maintain for the rest of the year, right? So, and we're talking about 2 months or something. I'm telling them a month. I'm telling them more about 6 weeks to like 3 months when the market goes up a lot, because you get paid. People are buying calls, so even the upside's a bit a little bit, and you just have some time and you can sit there and you're going to take in real premium, a 1.5%. It's like a dividend.
I'm trying to find the best way to answer this, because standard deviation is something that we hear often. What is a standard deviation, right?
Yeah, so standard deviation is simply a mathematical way to express how a stock can move. If you look at Coca-Cola, the standard deviation is the implied volatility, right? Also, when you that number. So when you think about
So if the implied volatility is 5%, 5% is standard deviation 1, and then another 5% for 10% is 2?
No, exactly. That would be the 2 standard deviations. Yes, you just multiply. Yeah, it's the exactly 1 standard deviation, 2 standard deviation. So when you're looking at Coca-Cola, might be or Pfizer or one of these drug names, might be like 25 vol. What does that mean? 25 IV. That means over the course of a year, the stock range will be up and down 20%. Okay, up and down 20%, or whatever it is, 25%, whatever the IV was, and 68% of the time. So I think that's the number. 1 standard is 68%. My mind's a little lost, but I think that's the number, 68%.
Yeah.
So it's called 68%. So 68% of the time it'll land between that 1 standard deviation, and the second standard deviation I think is like 90 some. I'm lost with the numbers right now, but it's 93 and 98%. So 3 standard deviations is like something that usually doesn't happen.
Yeah, I gotcha. Yeah, those things always kind of throw me off, because believe it or not, back in the day, I thought standard deviations were equivalent to strikes. So it's like, oh, go, 2 strikes. I'm like, oh, 2 strikes, that could happen tomorrow. So that doesn't make sense.
Right. No, but then if you're gonna take standard deviation, you can, and you're gonna use it over like 3 weeks. You can actually, it's a square root of time. So now you just like make a small calculation to say what's the standard deviation for 3 weeks, as opposed to 1 year.
Are leaps, speaking of 1 year, are leaps a good strategy for covered calls, like selling a leap that is a year out, a year plus?
You know what? You get paid, and if the market like looks really toppy, again, there's no right answer. Why not, right? Especially if you're saying, look, the portfolio's up 3 years in a row, 30%, 25%, and then this year it's going to be up another 25% or another 20%. All right, we get a nice spike here. Let's go another year and take in. Literally, you could take in a few percentage points, several percentage points over a course of a year, and yeah, I mean, it's not terrible, especially if it goes down, you've taken in a decent chunk of money. And the good thing is that with covered calls, it's hard to lose if you get one of these like down moves of 10%, because the market has to do that V shape. Does it always do that? Lately it has, but usually it doesn't, and historically. And if it just stops a little bit and takes its time to recover, all that time starts get eaten up on the premiums, that you'll have enough time to shift or get out or to move the strikes to a different level.
Yeah, and to kind of go ahead and pivot in that sense as well. Um, I think I asked this, but just in case I haven't, do you prefer covered call strategies on equities or on the indices?
Again, I think for everyone, if you're going to do this strategy the right way, again, it all depends on how much risk you want to take. When you do it on stocks, you take on more risk. When you do it on an index, it's 500 stocks, so it's diversified across 500 stocks, lower premiums, but you still get that diversification
Yeah,
that's needed in this stuff. Because if you own one stock, like you had Block, right, or Square at the time,
yeah,
you,
yeah, yeah.
you you long a stock, you sell calls, and the stock drops 30% on earnings. You take that one risk, that's tough. Now you get paid for it because the IV is higher, but still, the volatility of the P&L is a lot is larger than doing it on the SPY or the SPX. So
Yeah.
again, that's why I'm SPX, SPY, Qs. Also, the ability to get out quickly if you need to get out is
Yeah.
is there. That's what I would say.
I've also had folks who will go ahead and sell. Let's just say a stock is at 100 and a 1 month out expiration, they will sell 110 calls and then they will buy a 95 put as well, right? Just to kind of
That
hedge
would
the.
be the collar. Yeah, that's the collar. That is the collar. Yeah, to collar your position. So it's a call writing. Use that premium by the put, and now you're kind of locked in a range, and
Yeah.
that really dampens the volatility. So you could sleep at night. People say, "Look, I'll be happy up 10%, and down 5%. Okay, fine, I can live with that." And I paid very small or whatever it was for that structure. Yeah, that's how people tend to do.
I know you and I love the EV aspect of it, right? Like a plus EV. In this scenario, and this could be a whole session, so I'm not expecting an answer that'll
Yeah.
make me rip in 2 minutes. But how can people start thinking of covered calls in a plus EV way? One thing you said I really like was, hey, if the market is extended or one believes that the market is extended and you want to go ahead and sell one or two deviations higher, that may be a plus EV play. I like that thought process. Are there one or two other nuggets that you can give us to continue that thought process of plus EV?
Yeah, I mean, let's think about it. The at the end of the day, you're basically picking a spot of where you wanna sell stock, right?
Yeah.
And one thing I would say is that a lot of times people look at the IV. So just take a look at the SPY and they look at the VIX. Um, what 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 sometimes people don't realize is that when the VIX is at 35, it looks very expensive, but it actually a lot of times the VIX number is dampened because people know that it's mean reversion. They start selling it, they're buying puts on it and whatnot, that it's actually cheap relative to how it's trading. And, when the VIX is 12 or something very, very low, the realized volatility might only be like 5. That's when the options are actually more expensive. It's counterintuitive. And so when the VIX is sometimes really low, the market's not even moving enough to warrant that really low IV. Whereas when you get 30 vol, 40 vol, that means the market's whipping around. The market's like, maybe looking at a crash scenario, and you see how it might stop flat on the day, but intraday it was up 3%, down 5%, moving up, and you could be whipped around with that if you're looking at these calls in 3 week time periods. So oftentimes when the market is in distress, the volatility is actually cheap, believe it or not. For at least that day or the couple of days at 35. When the market is really just humming along and just doing its thing and lazy, and the volatility is very low, the IV is very low, the actual volatility of the index, how it's moving, is even lower. It's way lower, right? And so we'll get these times, especially during the JP Morgan collar. Think about those times during the JP Morgan collar where the market is not doing anything. It's literally up and down like pennies every day. And you're like, what is going on here? Right? It's like, oh, well, the market is long a lot of options. The volatility is getting crushed.
Yeah.
But it's still high. It's still expensive. Use that word
Yeah.
expensive versus historical and what it's actually doing.
Yeah. I am going to, I just, so I was thinking about this earlier, is I'm going to put my email address in the chat because we want to continue these conversations of options and things like that. So if there are topics that y'all love that you want us to talk about, let us know, because we're going to continue this series of conversations around options. But if there's anything particular that you guys want to learn about, let us know so we can have you join us. Felix, before we go, any final thoughts from you?
No, I think that's good. I think call overriding is a great strategy for long-term investors and has proven, there are studies that have proven to outperform the index. Where it doesn't perform well is in a bull market, like a straight up bubble type of market, which some people might say we're in.
Awesome. Sweet. Appreciate you. That is Felix Frey. Folks, we appreciate you for joining us. We will see y'all next week. Take care.
Take
Bye-bye.
care.